Hey there, welcome back to Making Financial Decisions, your go-to channel for all things finance and solar related. Today, we're going to take a deep dive into an economic phenomenon that's been catching the attention of some big names in finance. Ray Dalio, the founder of Bridgewater, one of the largest investment firms, recently released a research paper about the great wealth transfer. We'll be breaking down what's been happening, why it matters, and what it might mean for the future. But before we dive in, don't forget to show some love by hitting that subscribe and like button, and don't forget to turn on that notification bell if you haven't already, so you never miss another update. They're only getting better and juicier.
Long term, where we headed? Well, it's most important to me to not just answer questions like higher, lower, or whatever, but to try to explain the mechanics, the cause-effect relationships that are going on, right? And the reason I did this study, which then turned into a book, and I'm just a practical markets decision maker, is that three big things are happening in our lifetimes.
It's clear that something different is going on with the economy. The Federal Reserve's tightening isn't yielding the usual results. In fact, it's showing strength beyond expectations. But why? Well, the answer lies in a carefully orchestrated shift in wealth distribution. In 2020 and 2021, a massive wealth shift took place, government engineered. This shift moved wealth from the public sector, including the central government and central bank, to the private sector, households and businesses. This transfer made the private sector less sensitive to the Fed's rapid tightening of monetary policy.
Interest rates are low, inflation is low, and the Federal Reserve becomes stimulative and to buy those bonds. And so the Federal Reserve's got to come in there and print money and buy those bonds and redistribute wealth.
As a result of this strategic maneuver, household balance sheets and income statements are looking robust. While the government's financial situation is less than favorable, central governments globally are grappling with mounting deficits and losses on government bonds they issued. Central banks also resorted to printing money, driving up inflation. This type of maneuver isn't entirely new. History reveals similar shifts during different debt cycles. In 2020, this approach was labeled as Monetary Policy 3, also called MP3, following MP1 and MP2. MP3 centers on channeling funds directly to those in need, a symbiotic relationship between governments and central banks.
Right now, Monetary Policy 3 is when there needs to be a redistribution of wealth. And the way that works is that only the federal government can determine where the money goes. Yet the federal government gets to determine how much I tax and where I distribute it. And the central bank gets to determine how much there is of it, how much money there is of it. And so when the central bank works together with the central government to direct money to give it to others in that way, which increasingly then bypasses investors to some extent and gets money into the checks that we send money around to be able. And so we're in Monetary Policy 3.
Looking ahead, we see a period of moderate growth coupled with higher inflation, a kind of mild stagflation. In the long term, history suggests that government deficits will rise, possibly leading to market-imposed debt limits. Central banks might resort to printing more money and buying more debt, which comes with its own set of challenges.
You could judge the size of the deficits and how they're being met. And so the debt problem is not a debt problem like we're not going to pay you off those debts, because at the end of the day, they don't choose to pay them. They don't choose to have a debt crisis. At the end of the day, it's just a question of how long it takes them to print more money to monetize those things.
Now, let's visualize this journey with some charts. We'll take a closer look at various economic indicators over time, comparing recent developments with historical trends. The influx of government funds resulted in two significant spikes in total income, which caused spending to surge after a brief dip during the initial COVID phase. Real assets went up while debts remained relatively stable, leading to a surge in household net worth. This trend softened slightly due to the Fed's tightening but remains historically high. Unemployment rates plummeted while compensation saw significant increases, contributing to strong household balance sheets. Massive budget deficits and corresponding Fed bond purchases were a defining feature of 2020 and 2021, setting the stage for potential future debt dynamics. Nominal and real interest rates hit all-time lows during 2020 through 2021, then rose to more standard levels. Inflation surged but receded slightly, remaining elevated compared to pre-pandemic levels. Commercial banks' purchase of government bonds led to significant holdings. However, both commercial banks and the Fed incurred losses in these bonds. The disparities between countries, sectors, and businesses are greater than ever, making a comprehensive analysis essential. Structural changes, from domestic conflicts to technological advancements, are reshaping the economic landscape. So, there you have it, people of America, a whirlwind tour of the great wealth transfer and its impact on the economy. The charts tell a story of shifting fortunes, government interventions, and the resilience of the private sector. As we move forward, it's crucial to stay informed, keep an eye on the historical context, and consider the larger structural changes that are shaping our economic reality. If you found this breakdown by Ray Dalio, the prominent American billionaire investor and founder of Bridgewater Associates, useful, remember to hit that subscribe and like button to making financial decisions for more insightful discussions. Thanks for tuning in, and until next time, stay curious and keep learning.